When the US government shuts down, where does investor money go? Do stocks collapse or does gold surge higher? Could a political deadlock actually turn into a hidden opportunity for your portfolio? That is the question we are exploring today as we analyze the latest shutdown and what it really means for markets. On October 1st, the federal government officially went into shutdown. The cause is familiar: political gridlock between Republicans and Democrats over the budget. Republicans want to freeze government spending at current levels until Thanksgiving. Democrats want to extend healthcare subsidies and roll back cuts to Medicaid. With no deal reached before the deadline, hundreds of thousands of federal employees were left unpaid. While this does not immediately show up in hard data like unemployment or non-farm payrolls, reduced household income inevitably pressures consumer spending. That means slower growth for the US economy in the short term. Now let's turn to stocks. History tells us something surprising. In the 5 major shutdowns that lasted more than a day, US equities actually rose each time. That includes shutdowns in 1995, 1996, 2013, 2018, and 2019. Charts of the S&P 500 show that markets consistently trended upward during those periods. Why? Because investors quickly shift their expectations. When economic risk rises, the market anticipates easier monetary policy. In other words, the bad news of a shutdown often brings the good news of expected rate cuts, which in turn drives stocks higher. Today, the US economy is not in a recession, so any cuts from the Federal Reserve are more about prevention than crisis management. Historically, preventive cuts are bullish for equities. That is why this shutdown could once again act as a short-term tailwind for the market. But not every industry comes out unscathed. Defense contractors like Lockheed Martin, Northrop Grumman, and Raytheon may face delays in contract approvals and payments, putting pressure on cash flow and project timelines. Airlines such as Delta, United, and Southwest could also suffer, as agencies like the TSA and FAA deal with unpaid or absent workers, leading to delayed or canceled flights and frustrated passengers. The shutdown has also fueled a rally in gold. Prices hit record highs and notched a 6th straight week of gains. Why? Because the shutdown delays the release of crucial economic indicators such as non-farm payrolls. Without reliable data, the Federal Reserve faces a data vacuum, making it harder to set policy. That uncertainty makes gold more attractive as a safe haven asset. And the longer the shutdown lasts, the stronger the momentum for gold becomes. If the stalemate stretches for weeks, gold could continue to climb sharply. From a broader perspective, the shutdown does suppress some consumption, but inflation remains under control. That gives the Federal Reserve room to continue its current path of rate cuts. Analysts expect 2 more cuts this year, each by 25 basis points. If the shutdown drags on, the Fed could even accelerate the pace. That would mean even more support for both stocks and gold in the months ahead. So where does this leave us? For the economy, the shutdown is clearly a negative, but for markets, the story may be different. Stocks could climb on Fed easing expectations, while gold strengthens as a hedge against uncertainty. For investors, the challenge is not simply whether markets rise or fall. It is about identifying which sectors benefit and which sectors suffer. Defense and airlines may struggle, while gold and rate-sensitive growth stocks could shine. So here's the question for you: is this shutdown just a short-term boost or the beginning of longer-term risks? And how will you adjust your portfolio to capture opportunity while avoiding pitfalls? Share your thoughts in the comments, and if you found this analysis helpful, be sure to like this video and subscribe for more insights.